Hi everyone and welcome to this week's mortgage and property market update. It's the weekend of the 27th of February 2026. This has been a fairly quiet week on the economic front. No major data releases, no big surprises and no sudden market shocks. And actually that's not necessarily a bad thing because sometimes a bit of calm is exactly what the market needs. So this week we'll briefly touch on lender rate changes, what swap rates have been doing, some important criteria updates from lenders, and then because it's been a bit quieter economically, I want to spend a few minutes just looking at the cost of owning versus renting because that conversation is really starting to pick up at the moment. Before we get into it though, if you find these videos helpful each week, please take a second to subscribe to the channel. It really does help the channel grow and it means you won't miss the updates as we move through what's shaping up to be quite an interesting spring. So let's get on with it. As always, I've covered the detailed lender changes over on my Instagram stories, link on screen somewhere. So if you want the specific lenders and exact products, go and follow me over there because that's where I break it down properly. But at a high level, we have seen a few lenders continue to edge rates down. Nothing dramatic, no aggressive rate war headlines, just small incremental improvements in certain loan to value bands. And that's really the theme right now, steady positioning rather than panic pricing. And this links quite nicely into swap rates. And as you can see on screen, indicated by all the red, they have continued their slow drift downwards again this week. And we're now getting back towards levels that we haven't seen for quite some time. But, and this is the important thing, lenders are still being cautious. Yes, swap rates are lower, but margins are tight. So the pricing moves that we're seeing feel more business driven than funding driven. In other words, lenders are adjusting to hit volume targets, manage pipeline, and prepare for the spring rather than reacting to some huge economic turning point. And honestly, that's healthier. Controlled movement is better than wild swings. Now, in terms of criteria changes, this is where things have actually been quite interesting this week. NatWest has tweaked its higher loan-to-income lending again. They're already offering up to 6 times income for sole earners on £75,000 or joint of £100,000, but they've now removed the high credit score requirement that was attached to it. And that's significant. Because previously you might have earned enough, but if your credit profile didn't quite hit their internal threshold, you are out. Removing that opens access to more borrowers, particularly in areas where affordability is stretched. Then we've had Aldermore making some fairly progressive changes as well. They've improved loan-to-income limits up to 6 times household income, reduced stress rates on 2 and 3 year fixes, which boosts affordability, increased maximum age limits, and they're lending up to $1 million at 95% loan-to-value on certain tiers. They're also increasing flexibility for contractors, CIS workers, and zero-hour income with new gross income affordability assessments. So what we're seeing isn't reckless lending, it's lenders carefully widening access to more of the market. Now, briefly on comments from Andrew Bailey this week, which is about as close to economic data as we get. He said that he sees inflation falling to around 2% by April. Now, that's a bold call, and I genuinely hope it doesn't backfire on him. He did acknowledge services inflation is running higher than expected, and we do know that that's been one of the stickier areas. He also mentioned that recent US tariff developments aren't necessarily to the UK's advantage, so we're not operating in a completely clean global backdrop. And Hugh Pill has already cautioned that even if inflation does hit 2%, the Bank of England must not be complacent. But if inflation genuinely settles at target and stays there, yes, that would be positive for swap rates. And yes, it could bring forward base rate reductions. But let's not get carried away just yet. It's encouraging, yes, but it's not a green light. Now, because it's been quieter economically, I want to step back and take a look at something that's becoming more relevant again. The cost of owning versus renting. Recent Zoopla data shows that around 40% of homes currently for sale in the UK are now cheaper to buy with a mortgage than to rent locally. That's up from 25% a year ago, which is a meaningful shift in just 12 months. Regionally, it varies. In the northeast and northwest and Scotland, more than half of homes for sale are cheaper to buy than rent. Cities like Glasgow, Newcastle and Manchester, particularly flats, are now often working out cheaper per month on a mortgage than local rents are. London and the southeast are different, as you might expect, only around 36 to 40% cheaper to buy because property prices are still high even with lower rates. Mortgage rates in some areas are at 4-year lows, with certain fixed deals dipping below 4%. Stress testing has eased, typically around 6.5% now rather than 8.5% last year, and rental inflation has been strong, particularly in London. Now, these comparisons usually assume a 20% deposit, so it's not universal. With smaller deposits, buying can still be more expensive monthly. But what it does show is that the ownership equation is shifting again, and really the people who should be paying close attention are first-time buyers. Things are gradually improving for them. But we're now also seeing lenders improve affordability for home movers too. Higher income multiples, reduced stress rates, greater flexibility. And when first time buyers can buy and home movers can move, you start to get flow back into the system. And the property market in the UK runs best when there's flow. So whilst this week has been quiet on the headline front, underneath the surface, conditions are becoming more supportive. It's not a boom, but it is constructive. And that's a really good place to be heading as we go into the spring. Anyway, if you found this useful, don't forget to subscribe to the channel so you don't miss next week's update. And if you're thinking about buying, moving, or remortgaging this year, feel free to reach out. I'm always happy to have a conversation. But that's it for this week. I'll see you next week. Take care.